So as I was reading news about AI, a very interesting event caught my attention last week, and it reminded me of a historical parallel. So before I come to that AI event, I want to tell you a story about a fund called LTCM. Um, it was long term capital management, and it was launched sometime in mid 90s, and it was run by very smart people. In fact, some of them were Nobel laureates, Robert Merton and Myron Scholes. These were the guys who invented the formula for options pricing, and for that they won the Nobel Prize. So literally, the smartest people one could have on paper to run a hedge fund at that time. So they were so confident about their model that they took that idea and they launched the hedge fund. And the hedge fund bet against the impossibility of an event which their model predicted was maybe one in a the chances of it happening was maybe 1 in a billion. So literally practically impossible event. So and It looked to them that it was nearly risk free, so they took on a lot of leverage. They leveraged their portfolio by 25 is to 1. For every $1 of investor money, they borrowed $25, and that's how they amplified the return. So for 4 years the fund was minting money like anything, and it collected a lot of new investors, and everything was going well. And just when you think they couldn't be any more profitable, the fund blew up, because the event which their model said was impossible actually happened within the first 5 years. So and it was that Russians defaulted on their bonds, and that's where they were betting all their money on. And the whole almost all of the fund was wiped out, and the feds had to come and bail it out. But this is the event on which there was also a famous book written by Roger Lowenstein. The title of the book was When Genius Failed. The key takeaway for me from this story was that it does not matter how smart, intelligent, or a genius you are. When you bet using leverage, when you borrow a lot of money, then you lose the capacity to proven. You cannot bear being wrong temporarily, right? If you are proven long in short term, you should have the capacity to stay wrong and continue holding your bet. And this is what happens when you are taking a lot of leverage, that you are forced to sell out your positions. And that brings us to the AI, the similar event which has happened in the world of AI. So Leonard Aschenbrenner is a German prodigy. He graduated from the university at the age of 19 as a valedictorian, and then he joined OpenAI. He was reporting in a team called the Super Alignment Team, and he was talking to people like Ilya Sutskever, who are the absolutely smartest people in the inner core circle of AI. But within 2 years, he was fired from that for some misalignment between them. And after getting fired, he wrote a 165-page essay titled Situational Awareness. The essay talked about the AGI, the artificial general intelligence, that how soon it is coming back, the super intelligence, and the $1 trillion build out happening for AI. And somehow the essay went viral. In fact, some report that at one point the essay was being passed around in the Washington DC national security circles, and of course the Silicon Valley. It caught the fancy of Silicon Valley, and some of the who's who started giving money to Leonard Aschenbrenner, who launched a hedge fund of his own based on his situational awareness thesis. He named it as the Situational Awareness LP. And why did these people, for example, the Collison brothers from Stripe, the ex-CEO of GitHub, these were the guys who started giving money to Aschenbrenner. And what is it that they found so compelling in Ashenpreneur's essay was that it was simple and it was elegant. It had just one idea, one big idea, that the AGI is coming and that AGI is going to require a lot of physical infrastructure, the memory chips, the CPUs, the data centers, the power plants, and all this will benefit companies who are building this infrastructure. So Situational Awareness LP invested in companies like Broadcom, Micron, South Korea's company SK Hynix, and at the same time it also bet against a few companies. So it reasoned that as AI is coming, a lot of traditional old software companies will be disrupted. For example, Adobe. So he did a short selling for these legacy businesses. Now, so far so good, but the chink in the armor for Leonard Ashenpreneur was to amplify the returns. He also took on debt. So he was so confident about his what he had predicted in his essay that he leveraged his portfolio. So he took on 4:1 debt. For every $1 of investor money, he borrowed 4 more, and that amplified his return. In fact, in the beginning of 2025 first half, his fund returned 47%, which was not just beating the market but embarrassing the market. And it is said that in July, the third week of July, the last letter that he sent to his investors, it claimed that they had done 400% return in the first half of this year, 2026. So that's the kind of insane returns it was claiming, and at the peak it was managing $45 billion. Now imagine that, a 24-year-old guy who has no experience in managing money ever, he is managing $45 billion, $45 billion of investor money within just 2 years. And in the last week of July, what happened was many of these companies which were in the portfolio of Situational Awareness LP, their stock prices pulled back a little. It was not really a panic as much, but it did just pull back. And at the same time, the companies on which they had put a short sell, for example Adobe, their stock price went up. So with these two events happening at the same time and their portfolio being leveraged, all this margin calls started happening. So JP Morgan, Morgan Stanley, Goldman Sachs, all of them came calling back saying that put up the money for the margin call. And that's when Leonard had to force sell his public stock portfolio, and within few days his $45 billion fund was cut down to $10 billion. So he lost $35 billion within a matter of few days. Now in all this mayhem, it is still very much possible that the situational awareness prophecy still plays out. Leonard Ashenpreneur is still proven wrong and is still proven right. In fact, directionally he might still be right. All that AI build out is real. It is happening right now. It's not that it has collapsed. But the thing was, taking on debt made it impossible for Leonard to sustain temporary drawdowns. And that's what debt does to you. In fact, it reminds me of a famous quote from economist John Maynard Keynes, who said, "The markets can remain irrational longer than you as an investor can remain solvent." So that is the dagger of debt, and that reminds me a very good analogy that Warren Buffett once gave. He says, taking on a lot of debt to operate a business is like driving a car where the steering wheel has a dagger mounted on it and it is pointed towards your heart. So in this situation, you'll be very careful while you're driving and the chances of accident is less, but when it happens, it will almost always be fatal. And that's what happened. Even in the case of Leonard, he's just 25. It might happen that he still has $10 billion left. He might still move on continue investing. In case of LTCM also, the founders, when they lost money, they eventually moved on, they started their own other funds. But the point is that whenever you see that somebody is offering you returns which are super normal, which are too good to be true, before you jump into it, ask yourself whether all of that is because of the skill, or whether there is a leverage behind the scene um, which is reflecting as supernormal returns. The biggest irony in this story, the LTCM story, the Leonard Aschenbrenner story, is that he graduated from him and Warren Buffett, both of them have one common thing between them, which is they both graduated from Columbia University. Talk of the irony.